Hey everyone, and welcome back to the channel. Today, we're diving into a question that trips up a lot of new investors. When you've got cash ready to invest, should you put it all in at once, or spread it out over time? We're talking about the classic showdown: stock savings plan versus one-time purchase. Visual, split screen graphic with stock savings plan on one side and one-time purchase on the other, with icons representing gradual versus immediate investment. Section 1. The big picture. What are we even talking about? So you've got some money saved up. The big dilemma is how to get it working for you in the stock market. Do you go with a one-time purchase, where you invest a chunk of cash all at once? Or do you opt for a stock savings plan, also known as dollar cost averaging or DCA, where you invest smaller amounts regularly, say, every month? Visual, on-screen text. One-time purchase, all in all at once. And stock savings plan, DCA, small amounts, regularly. Both are super common, and the best choice depends on a few things: your financial situation, how much risk you're comfortable with, and how long you plan to invest. Section 2. The numbers game. What history tells us now. Let's look at the data. From a purely mathematical and historical standpoint, there's a clear winner for long-term investors: the one-time purchase. Studies from big names like Morgan Stanley and Northwestern Mutual show that investing your lump sum all at once has historically led to higher returns, in a majority of cases, sometimes over 75% of the time. Visual, graphic showing historical performance comparison. Maybe a bar chart with one-time purchase consistently higher than savings plan over long periods. On-screen text. Data favors one-time purchase historically. Why? It's all about time in the market versus timing the market. When you invest all your money immediately, it starts earning returns and benefiting from compound interest from day one. The savings plan, by spreading out your investment, means some of your money is sitting on the sidelines, not earning as much. Section 3. The human factor. Why we worry. But here's the twist: investing isn't just about numbers, it's also about psychology. This is where the stock savings plan shines. It's a fantastic tool for managing risk and easing our anxieties. Visual, a graphic with a person looking stressed at a falling stock chart for one-time purchase, and a calm person with a steady upward trend for savings plan. With a savings plan, you buy more shares when prices are low and fewer when they're high. This cost average effect smooths out your average purchase price, making it less stressful. It protects you from the fear of investing all your money right before a market crash. It's about building discipline and routine, making investing less emotional and more consistent. Section 4. The practicalities, fees, and flexibility. Let's talk about how these actually work. Visual, split screen comparing features. Savings plan, low entry, flexible, automated. And one-time purchase, larger sums, requires timing decision. Stock savings plans are incredibly accessible. You can often start with as little as €25, and they are super flexible. You can adjust, pause, or stop them anytime. Plus, many allow you to buy fractions of shares, so you can own a piece of even expensive stocks. Visual, close-up of a phone screen showing a simulated savings plan setup with a small monthly amount. One-time purchases are typically for when you have a larger sum available, like from a bonus or an inheritance. You're making a deliberate decision about when to enter the market, hoping to get the best possible entry point. Now, fees are important. Visual, a simple table showing typical fees for savings plans versus one-time purchases, highlighting the critical limit, where one becomes cheaper than the other. Savings plans often have a fixed fee per transaction or a small percentage. One-time purchases usually have a fixed fee based on the amount. Depending on the broker and the amount you're investing, one might be cheaper than the other. For example, if you're investing smaller amounts regularly, a savings plan might be more cost-effective. If you have a much larger sum, a one-time purchase might have lower total fees. Section 5. The Royal Solution: Best of Both Worlds. So what's the verdict? For most people who invest surplus income regularly, the stock savings plan is an excellent, realistic, and psychologically sound choice. It promotes discipline and reduces stress. Visual, on-screen text. For regular investors, savings plan equals practical and psychological win. But what if you have a lump sum? Here's where we get smart. A really effective strategy is to combine both. Visual, graphic illustrating the combination strategy. A large portion of a pie chart going into a one-time purchase box, and the remaining smaller portion going into a savings plan box over time. Let's say you have 10,000 euros. You could invest half of it immediately as a one-time purchase to get that immediate market exposure. Then, you could invest the other half over, say, 10 months using a savings plan. This way, you benefit from the statistical advantages of investing early, while still smoothing out your entry and reducing the risk of a bad timing. Visual, real-world example. Invest 5,000 euros now, one-time purchase, plus 500 euros per month for 10 months, savings plan. Section 6. Key takeaways and your next step to wrap it up. Historically, one-time purchases tend to perform better over the long run. They maximize your capital's time in the market and compound interest. Savings plans are psychological powerhouses. They reduce risk, build discipline, and make investing less intimidating. For most people investing regularly, savings plans are the most practical and effective route. If you have a lump sum, consider a hybrid approach. Invest a portion at once and dollar cost average the rest. Visual, recap slide with bullet points of the key takeaways. Ultimately, the best strategy is personal. It's about what fits your financial situation and your comfort level. The most important thing? Don't let the complexity stop you from investing at all. Holding cash long-term is actually the worst strategy due to inflation. So decide what works for you and take that first step. Whether it's a savings plan or a one-time purchase, getting your money working for you is the key to building wealth. Visual, final screen with channel logo and a call to action. Subscribe for more investing tips. Thanks for watching, and I'll see you in the next video.